So in 2025, 1 out of every 4 new cars sold globally was electric. Which, I mean, by all accounts, if you just look at the raw numbers, the electric vehicle revolution has pretty much been won.
Right. On a paper, it looks like a total victory.
Yeah, exactly. But then if you actually look at consumer surveys right now, buyers are panicking. I mean, they are hesitating, they're second-guessing, and a lot of places they're actually leaning back toward traditional gas engines.
Which is wild to see.
It really is. So welcome to the Deep Dive. Today, we are mapping out this massive, just completely contradictory paradox that is the global EV landscape right now in 2026.
It's a very confusing time.
It is. And we're doing this to help you cut through the absolute avalanche of headlines and, understand what is actually happening out there on the roads. And probably more importantly, what is about to happen in your own garage.
Because that's where the real changes are hitting.
Exactly. And to do this, we've pulled together a massive stack of research today. We're pulling insights from the 2025 Global Automotive Consumer Study by Deloitte, the Global EV Outlook 2026 from the International Energy Agency, a really fascinating report on the home charger market from Energy Now, and finally 2 incredibly detailed infrastructure analyses from Wood Mackenzie.
Yeah, that Wood Mackenzie data is dense, but so important. And it really is a paradox we're looking at. On one hand, you have this undeniable, just staggering macroeconomic momentum.
Right.
But then when you zoom in on the psychology of the person actually walking into a dealership, it is just, well, it's a period of intense awkwardness and anxiety.
Like a teenager's growth spurt or something.
Exactly like that. Fast, breaking records, but incredibly awkward. And the mission for us today, and for you listening, is to really bridge that gap.
Yeah.
We need to figure out why the data looks so triumphant while the consumer feels so hesitant.
Yeah, and where this industry is actually heading.
Right, and why the biggest, most lucrative battleground right now isn't actually the car itself, it's the plug.
It's the plug. Okay, so let's start by looking at that triumphant data first, because the headline stats from the International Energy Agency are just wild.
They really are.
Global EV sales topped 20 million in 2025. And China is absolutely dominating the board here. They have a 55% domestic EV sales share, and they are supplying, get this, 60% of all global electric car sales.
It's a massive market share.
Huge. Then you look at Europe, which saw a 30% jump in sales, mostly driven by tightening CO2 emission standards. But then you look at the U.S., and sales remained relatively stable, just hovering right under 10% of the total car market.
Yeah, so the growth is highly regionalized, obviously, but the aggregate global number is shifting the entire automotive landscape.
Hold on, though, because that doesn't completely track with what we've been seeing in the news lately. I mean, the policy landscape recently hasn't exactly been a red carpet for EVs, right?
No, definitely not.
Like the U.S. ended major EV tax credits, and China temporarily paused its massive vehicle trade-in scheme in 2025.
Right, because of funding limits.
Yeah, funding limits and issues with what they called zero-mileage cars. So if those massive government discounts and policy tailwinds were removed or paused, who is buying 20 million electric cars? Like, how are sales breaking records without those subsidies?
See, that is the multi-billion-dollar question right there. And the answer is that the momentum has essentially detached from local car policies and attached itself to massive global forces.
Okay, what kind of forces?
Well, there are 2 underlying drivers really keeping this momentum going. The first is the ongoing energy crisis stemming from the Middle East.
Right.
High oil prices have a way of making the economics of an electric vehicle undeniable, right? Like, no matter what a local government does with tax credits. When oil spikes, the running costs of an internal combustion engine become a serious, immediate burden on a household budget.
Which hits people right in the wallet every single week at the pump.
Exactly. To give you an idea of the scale here, the IEA looked at April average oil prices. Based on those numbers, the annual fuel cost savings for driving an EV in Europe jumped 35% in just a single year.
Oh, wow. Wait, 35%. Let's make that real for a second. If you're listening to this and you spend, say, $200 a month on gas, imagine that dropping down to practically a rounding error on your electricity bill while gas prices just keep climbing.
Yeah, a 35% jump in savings is massive.
It's life-changing money for a lot of people.
It is, and when you multiply that by millions of drivers, it literally reshapes the global economy.
Yeah.
The total fleet of EVs actually displaced about 1.7 million barrels of oil per day in 2025.
That's incredible.
And then the second major driver pushing these sales numbers up is the export market. specifically from China.
Right. You mentioned they supply 60% globally.
Yeah, Chinese manufacturing has reached a level of scale and efficiency that is, frankly, hard to comprehend.
Yeah.
They're dealing with massive domestic overcapacity, so they're just exporting highly affordable vehicles to emerging markets.
Because they can build them so cheaply that they can ship them across the world and still completely undercut the price of a local gas-powered car.
Exactly. Chinese exports doubled to 2.5 million vehicles last year, and this is completely redrawing the global map. Southeast Asia saw their EV sales more than double, reaching a nearly 20% sales share.
Wow.
And Latin America grew by 75%.
So it's not just a North American or European story anymore. I mean, the transition has truly gone global.
Very much so.
And if you've noticed a lot more affordable, maybe unfamiliar EV brands popping up on the road lately, or if you've really felt the sting of gas prices recently and started doing the math on an EV for your family, well, you are experiencing these massive macroeconomic shifts firsthand.
Yeah, you're living it. The macro environment is practically forcing the transition forward. But, and this is the big red but, as we established right at the top, when you leave that macro data and zoom in on the individual consumer, the psychology of the buyer is a completely different story.
Which brings us to this fascinating Deloitte study. Because they surveyed over 30,000 consumers across 30 different countries.
A huge sample size.
Yeah, huge. And what they found is that BEV inertia, meaning the hesitation to jump fully into a pure battery electric vehicle, is a very real, measurable phenomenon.
Yes.
Instead of diving headfirst into electric, consumer interest in internal combustion engines, and particularly hybrid vehicles, is actually ticking back up.
Right, because consumers are actively looking for a bridge. They see the 35% fuel savings, and they want those lower operating costs.
Of course they do.
But they are absolutely terrified of the charging infrastructure. I mean, they don't want to be stranded on a road trip with a dead battery and nowhere to plug in.
It's like they want training wheels for the EV transition.
Training wheels, yes.
They want the best of both worlds, right?
Yep.
They want to commute to work on cheap electricity, but they still want that gas tank sitting there as a safety blanket just in case they can't find a public charger.
The training wheels concept captures it perfectly. And what's really interesting here is how this anxiety, when you combine it with the new technology, is completely destroying traditional brand loyalty.
Really? How so?
According to the Deloitte data, intended brand defection, which means people planning to switch to a totally different automaker for their next car, is rising all over the world.
Why is that happening, though? I mean, for 100 years, people were Ford families or Toyota families. You bought a brand because you trusted their engines and their reliability, you know?
And that right there is the exact mechanism. For a century, the differentiator was the internal combustion engine. Who builds the most reliable engine? Now, the engine is essentially just a giant battery pack on a skateboard chassis.
Right.
The new differentiator isn't the hardware anymore. It's the software. It's the infotainment system, the autonomous driving features, the battery management.
Oh, I see.
And legacy automakers are really struggling to build good software. So consumers, especially in places like China, where a massive chunk of buyers are first-timers without decades of brand loyalty, they're turning to tech-first startups. They are entirely open to whoever offers the best digital experience.
So the car is basically becoming a gadget. And you wouldn't necessarily buy a smartphone from a company that specializes in making typewriters.
That is a harsh but very accurate way to put it. And the shift goes even deeper than brand loyalty, actually. The fundamental relationship with the automobile itself is fracturing.
How do you mean?
Well, the Deloitte study highlights a massive trend among young people, specifically that 18 to 34 demographic in places like the US, India, and Southeast Asia. There is a significant growing interest in giving up traditional car ownership entirely. They're leaning toward MaaS, which is mobility as a service.
Okay, so think of MaaS as your ride shares, your robo-taxis, your subscription car services. But here is the part that confused me in the data, actually. The study also shows that in India, Southeast Asia, and the US, half of these young consumers surveyed drive a vehicle every single day.
Right, they rely on them.
They rely on cars constantly.
Yeah.
So why on earth do they want to give up owning one if they need it every day?
Because the hidden costs of ownership have just become crushing. I mean, insurance premiums for young drivers have skyrocketed recently.
Right, absolutely.
Parking in dense, growing cities like Jakarta or New York is increasingly expensive and sometimes completely impossible. Routine maintenance is a headache. These younger demographics, they want the mobility they need to get to work or see friends, but they desperately want to shed the financial and logistical liability of the physical asset.
They want the ride, not the car.
Exactly. Furthermore, consumer purchasing power is constantly being altered by the policy environment right now. Let's look at recent legislative realities in the United States, for instance. The recently passed One Big Beautiful Bill, or OBBB, ended EV purchase tax credits 7 years earlier than originally planned.
And just to be clear for you listening, we're looking at this purely through the lens of market mechanics, right?
Yeah.
The OBBB is a major legislative shift, and Wood Mackenzie specifically modeled its market impact. We were just impartially reporting the data here.
Right, we're just looking at the math. And Wood Mackenzie predicts that removing those purchase tax credits will reduce the projected 2030 EV sales share in the U.S. by a full 3%.
Wow.
It's basic economics. When a massive government discount disappears, fewer people can afford the product, and sales projections have to adjust downward. The math just changes for the consumer overnight.
Yeah, that makes sense. So look at the perfect storm we have brewing here. We've got crippling range anxiety, the death of century-old brand loyalty, an entire generation wanting to avoid car ownership entirely, and the rolling back of financial incentives in major markets.
It's a lot of headwinds.
It is. So if you are a company operating in this space and you see that range anxiety and policy rollbacks are the biggest bottlenecks to adoption, the logical conclusion is that whoever solves that anxiety stands to make an absolute fortune.
Yes, precisely.
We have to stop obsessing over the cars themselves and start looking at the infrastructure.
The infrastructure is the bottleneck, which makes it the single greatest financial opportunity of the decade.
I was looking at the numbers from Wood Mackenzie on this, and the sheer scale of the charging build-out we are attempting globally is just, it's hard to wrap your head around. They project the world is on track to have 206.6 million EV chargers by 2040. And to get there, it is going to require a $300 billion global spend.
That requires an immense amount of physical capital, urban planning, and just a massive expansion of grid capacity.
But wait, how does that work with the policy changes we just talked about?
Yeah.
You mentioned the OBBB rolled back purchase credits, but Wood Mackenzie noted it also killed the IRA 30C tax credit. For those of us who don't read tax codes for fun, what was the 30C credit and what happens now that it's gone?
Right. So the 30C credit was essentially a federal subsidy designed to help companies and individuals offset the massive cost of installing charging infrastructure.
Okay.
With the OBBB removing that support by June 2026, Wood Mackenzie noted a resulting 9% spike in EV supply equipment costs. The hardware just got significantly more expensive to install across the board.
So if costs are spiking by 9% and government support is vanishing, shouldn't the companies building these networks be terrified? Like, why are they still pouring billions of dollars into concrete and copper?
Well, the headwinds are definitely real, but the market data shows incredible resilience. Despite those policy shifts and cost spikes, the U.S. public charging network still grew by 5% in just the second quarter of 2025 alone. What we are seeing isn't a retreat, it's a massive consolidation.
Oh, I see. The big fish are eating the little fish.
Exactly.
The companies with deep pockets are surviving the cost spikes, while the startups just fold.
Yeah, major players with proven operational capabilities are taking over the board. ChargePoint, for example, captured 50% of all Level 2 charging growth in that quarter. Tesla's supercharger network also had its second highest quarterly deployment ever.
That's crazy.
But to truly understand where the $300 billion is going, we have to look past the public charging stations you see at the grocery store or the highway rest stop. The real gold rush is residential.
The multi-billion-dollar garage.
Yes. According to the Energy Now report and Wood Mackenzie's long-term forecasts, residential charging is going to absolutely dominate the entire landscape. By 2050, 2 out of every 3 charging ports worldwide will be located at someone's home.
That's a huge shift.
It is. EV owners already do an estimated 80% of their charging in their own driveway. This is why you are seeing massive legacy energy companies, oil giants like BP and Shell, and massive utility companies like France's EDF frantically buying up home charging startups. BP bought a company called ChargeMaster, for instance. They are reading the tea leaves. They know that the driveway is the new gas station.
Okay, let's pause here because this is the part that kind of breaks my brain a little bit. Why on earth does an oil giant like Shell care up to the little plastic box bolted to the drywall in my garage?
Right.
I mean, it's just dispensing electricity, right? It's a glorified wall outlet. What is the actual business model there?
It is so much more than a wall outlet, and this brings us to really the most transformative part of this entire deep dive. Because once your car is plugged into that home charger, it ceases to be just a vehicle. It becomes a vital, interactive node on the power grid.
A node.
Yeah. The automotive industry calls this the shift toward the software-defined vehicle, or SDV.
Okay, meaning the car is basically a rolling computer.
A rolling computer attached to a massive battery. And the game changer here is a technology called bidirectional charging, often referred to as vehicle-to-grid or V2G.
Wait, to grid, meaning the flow of electricity isn't just coming out of my house and into the car, it goes backward.
It goes both ways. Bidirectional charging allows the EV owner to draw power from the grid at night when demand is low and electricity is incredibly cheap. Your car charges up while you sleep.
Makes sense.
But then during the peak hours of the day, say 5:00 p.m. in August, when everyone comes home, cranks up their air conditioners, and the grid is stressed to the breaking point.
And power is super expensive.
Exactly. Power is incredibly expensive. At that moment, your car can actually sell its stored cheap energy back to the grid at a premium.
So my car is basically acting like an automated day trader. It's buying low at 2 a.m. and selling high at 5:00 p.m. on the electricity market, all while it's just sitting parked.
That is exactly the mechanism. And this is the real so what for why these massive energy companies want to own your home charger. They don't really care about selling you the physical hardware. They want the data.
The data. Wow.
Yeah, they want to be the software layer that controls the flow of energy across millions of cars simultaneously. Imagine a company that can aggregate the batteries of 100,000 cars plugged into garages across a single city.
That's huge.
By coordinating when those cars charge and discharge, that company essentially controls a massive decentralized power plant. Monetizing that grid balancing data is the ultimate prize.
That is staggering. I mean, if my neighborhood loses power, my neighbor's EV could potentially keep their house illuminated or even feed power back to stabilize the local block.
Entirely possible.
And it's not just personal cars sitting in garages we have to think about either, right? The commercial sector is moving just as fast. The IEA report noted that electric heavy-duty commercial truck sales doubled in China last year.
Yes, doubled.
1 out of every 4 massive freight trucks sold there was electric. And then Wood Mackenzie highlighted the rise of autonomous vehicle fleets, too.
And those autonomous fleets are the wild card that grid operators are really sweating over right now. You have companies like Waymo operating 1,500 vehicles right now with plans to add thousands more.
Right. And a robotaxi doesn't sleep. I mean, a personal car sits in a driveway for 12 hours a day, which is perfect for that slow overnight charging. But an autonomous taxi or a commercial freight truck is trying to maximize uptime. They need to be moving to make money.
Which fundamentally alters how power is consumed in a city. These fleets require incredibly sophisticated hybrid charging strategies. And this brings us to the difference between level 2 charging and DC fast charging.
Okay, let's break that down for those of us who just plug our phones into the wall. What's the actual difference in how these powers power a massive vehicle?
Think of level 2 charging like a garden hose. It provides a steady, relatively slow flow of power. It's cheap, it doesn't stress the battery, and it's perfect for overnight depot parking when the truck or taxi is out of service.
Okay, got it. Garden hose.
DC fast charging, on the other hand, is like a fire hose. It bypasses the car's internal converter and blasts the battery full of direct current in minutes. It's incredibly expensive and requires massive grid infrastructure, but it is exactly what a robotaxi needs to get a quick top-up during a driver shift change so it can get back out on the road making money.
So these fleet operators need the garden hose for the night and the fire hose for the day.
Yes. And the power grid has never had to handle roaming, unpredictable clusters of massive power demand like this before. Imagine 50 electric freight trucks all pulling up to a highway DC fast charging hub at the exact same time.
That would be a huge draw.
The local grid demand spikes instantaneously. It is a complete paradigm shift in how we generate, store, and transmit energy.
So for you listening, the next time you are walking your dog and you see an EV plugged into a neighbor's driveway, or you see an autonomous taxi humming down the street, you shouldn't just see a car anymore. You are looking at a roving, AI-driven power plant. You're looking at the literal rewiring of the global energy grid playing out in real time right in front of your house.
It really changes your perspective.
It absolutely does. Well, let's take a breath and summarize the massive amount of ground we've covered today. We started by looking at the central paradox of 2025. Global sales are breaking records. topping 20 million, completely reshaping a global export map driven by Chinese manufacturing and the sting of oil prices.
Right.
Yet, at the exact same time, individual consumers are showing deep, paralyzing anxieties about range, demanding hybrid training wheels, and completely shedding their century-old brand loyalties in favor of better software.
The transition to gadgets.
Exactly. Then we explored how the solution to that consumer panic has triggered a $300 billion gold rush in charging infrastructure, specifically targeting the residential garage, despite those massive policy headwinds. And finally, we saw how that unassuming garage charger is transforming the car from a simple mode of transport into a grid-balancing, day-trading energy hub.
And that technological evolution actually brings up a final, provocative thought I'd love to leave you with today.
Oh, lay it on us.
We've established that the car of the future is essentially a localized energy trading asset. Through bidirectional charging, it will automatically balance national power grids and generate active daily revenue for the owner.
Right.
If that is the case, will the automaker of the future eventually look less like a traditional manufacturing company, stamping metal and assembling parts, and more like a Wall Street high-frequency trading firm?
Oh, wow.
Think about it. If the object sitting in your driveway can actively generate revenue by trading energy on the open market while you sleep, the fundamental century-old economics of what it means to own a vehicle might soon be completely inverted.
It really makes you rethink that idea of mobility as a service we talked about earlier. Maybe in the future, the car pays for itself. Well, thank you so much for joining us on this deep dive. Keep your eyes open, keep asking questions, and keep exploring the invisible systems that are powering your world.